Hi, everyone, and welcome to today's webinar with Tax Connects. We're going to talk all about managing a sales tax audit. My name is Liz Brigson. It's always great to be your host, and I'd love to review a few things to help you get the most out of the program today. First of all, you can utilize the GoToWebinar questions pane to interact with us throughout the webinar. So if you want to say hi, let us know where you're joining from. We'd love to hear from you, and hopefully my audio sounds good to everyone. If not, go ahead and let me know. You can download the handouts for today's presentation from the GoToWebinar control panel. Today's webinar is 1 hour. We'll launch 4 polling questions, and as long as you respond to 3 of the 4 polling questions and remain logged in for at least 50 minutes, you'll qualify for CPE credit, and you can access your CPE certificate directly from your Encorsa dashboard an hour after the end of the event. If you have any questions about the webinar, feel free to email us afterwards at support@encorsa.com. And I'm on LinkedIn. I'd love to connect with you, and the Tax Connects team is out there as well. So go ahead and head out there and send a connection, and we'd love to stay in touch that way. It's my pleasure to welcome back our guests. We have 2 experts in this area. We have Jeff Meags, who's a partner with Tax Connects, and Brian Greer, who is also a partner. Jeff is the consulting practice leader, and Brian is the chief revenue officer. These 2 gentlemen have been working together for just about 2 decades. They have just a really wealth of knowledge to share on this topic. So I'm happy to turn things over to the both of you, and you can go ahead and take it away.
Hey, thank you, Liz. I'm Brian Greer. Appreciate everybody being on the call with us this afternoon. We were talking a little bit before we got started about the weather, where we're all located, and Liz is up there in Michigan, and I think got some snow recently. And I shared with her that I was super fortunate when I traveled up to Ann Arbor about 2 weeks ago, and it was 80 degrees. So I guess that's a typical upper Midwest weather pattern to go from 80 to snowing in the matter of a couple of weeks. But happy to be here with everyone. I know there's people dialed in from all over the country, so we appreciate you hopping on here with us. Just a little bit of background on our business here. Liz introduced Jeff and myself a little bit, but talking about Tax Connects a little bit more specifically, we do focus in this sales and use tax industry. We're kind of wacky from that perspective that we've made a career out of doing nothing but sales and use tax. But within the business here, we have 2 primary service lines. And as Liz mentioned, Jeff specifically heads up our consulting service line. And, within that group, we're doing a lot of projects related to helping companies understand where they have nexus, where their revenue streams are subject to sales tax. We do some exposure reviews, voluntary disclosures, and of course, today's topic, sales tax audits. The other service line that we have here at Tax Connects is a compliance outsourcing service, where we essentially become an outsourced sales tax department for our clients and manage the registration, filing, remittance process, responding to notices, that type of monthly kind of administrative process. So let's get to the webinar here in terms of, I'll quickly talk through the agenda. I think we might have a polling question right after that agenda before we get into the meat of the discussion. But this is always a hot topic for us and a well-attended webinar. I think there's always concerns with audits. I think there's always a perspective that the states are hungry for cash and like to audit us, like to audit businesses. So there's always questions about, how do I get selected for audit? I don't know if there's really any one single right answer there, but we'll kind of talk through that a little bit. And also just talk through managing the audit itself, how to respond, what to do after the initial assessment comes out, what options are available even after a final assessment. We'll talk through all that. I think Jeff's a great resource to have this conversation. I'll probably say less during this presentation than I have on some of our other ones, if you've participated in the past. But, Jeff has a background as a former auditor that goes back literally decades ago, but also working in industry and working from a consulting perspective here, and not just at Tax Connects, but with other accounting and tax firms as well. So he's got a good perspective from a lot of different angles here in terms of how to manage and how not to manage audits as well. So glad that he can share his wisdom with us here today. So before we get started, Liz, I'll let you go ahead and pull up the first polling question here, and then we can get started.
That sounds great. The first question for the audience is, have you seen a change in the number of sales tax audits your company has experienced in the past 2 years? So go ahead and respond to this polling question in the quick poll box. And for those of you who said hi and let us know where you're joining from, that's awesome. Welcome. And if you respond to the polling question, then you want to write into the questions box and let us know what state you're in. That would be really interesting to see if there's any states that have had a greater increase than others. And would you say at Tax Connect, how have you seen the trends here with your clients?
Yeah, it's a good question, Liz, and it's interesting that I don't know if we would say that we've seen more audits happen. I think when we talk with clients, the expectation is that more audits will happen in the future. We do an annual survey, and I think we just finished our third annual survey, not just finished, but at the end of last year. And there's always this expectation that there will be additional audits in the future. But then we also ask, have you seen an increase historically? And it doesn't really align. I think there is a expectation of more in the future, but they don't necessarily seem to happen. We're busy managing audits for clients, but it's not necessarily, I wouldn't say, an increase or a decrease in the number that we're managing.
So it sounds like there's a big perception there, but maybe it's more level than anything. And I'll close the poll and I'll share the results. And we can see that majority of the audience here, 46% say that says the number has stayed the same. But we do have 20% of you have reported an increase, 5% of you have reported a decrease. If you don't know, that's okay. But I think it's pretty interesting just to see how those statistics stack up. So thanks everyone for clicking in your result, and I'll go ahead and close the polling question.
Yeah, and I wish I had the specific metrics from that survey we did at the end of last year. I'm sure my marketing people are laughing that I don't have the exact information on the tip of my tongue, but it seems like it aligns with what you showed there, Liz, in terms of most of the audience tends to respond that they've stayed the same, but then that perception that they're expecting more in the future. And that's been this kind of the same answer for 3 years running. They've stayed the same, but there's this expectation that they're coming. So at any rate, appreciate the audience responding to that and sharing your thoughts with us. So I'll turn this over to Jeff here for this next piece.
Yeah, just kind of piling on to what Brian, Liz were talking about, anybody that's going through an audit is going to feel like there is no end, particularly if there's multiple audits going on at the same time. And I think the message that we would share with you today, I think throughout this presentation, is prepare yourself for the inevitability of an audit and stop worrying about whether or not it's going to happen. Just expect that it could happen, and to the extent you're prepared for it, it shouldn't create a whole lot of problems for you. So as Brian said, we do get this question quite a bit. How and why are companies selected for audit? And there are a variety of reasons why companies are selected for audit. Most of the time, our clients don't know the answer as to why they were selected. Sometimes auditors will share that with you, sometimes they won't. Historically, going back a number of years, I found in my own experience that the best audit opportunities were found through audits of other companies. So I'll talk a little bit about that first, but it's not necessarily in the same order as we've got this slide here. So historically, when a company was audited, we're looking at two sides of an equation. One is their sales activity. Are they adequately charging tax where they should be and at the right rates and on the right products and services? And two, are they paying tax when they should be on their purchases of tangible personal property and services? When you look back in time, the states were heavily reliant upon self-accruals, meaning the states had little, if any, authority over interstate commerce unless somebody had a physical presence in their state. And so there tended to be a lot of business transactions whereby sales and transfers of tangible personal property took place and the vendor was not charging tax, and it was up to the customer, the consumer, to pay that use tax. And so auditors would look at those activities and those transactions, and over time they would start to see a trend, and they would start to realize, hey, this company looks like they're maybe providing some services in this state. They probably have a physical presence, and I never see them charging tax on their invoice. I'm going to call them up and see what we can find out. Or it could be a vendor that's just down the street that just doesn't understand their compliance obligation and has a lot of misses on their invoices and may be inconsistent in the way they present the tax on their invoices. So they become a target. So out of every audit I would conduct, I would inevitably come out of that audit with 2 or 3 more audits. So there was a never-ending supply chain in that regard. When you look at what we have today, the economic sort of platform that we operate on is a good bit different. With the Wayfair decision in 2018, there's now an economic nexus standard, which starts to require compliance of many more companies than ever before. And the physical presence test still exists, but it's not the only test. And so I think there tends to be a lot less in the way of consumers' use tax exposure than there used to be. But I think the states are starting to get a little more active when it comes to identifying candidates for audit. And the Wayfair decision, I think, afforded them that opportunity. So we are starting to see more states send out what we call nexus questionnaires to companies. And they do sort of have a spin associated with Wayfair, associated with an economic nexus standard. And I think that net is starting to get cast and is catching a lot of good protein these days. So nexus questionnaires, audits of other customers, audits of your vendors. Prior audit history is a pretty good indicator. Certainly if you've gone through an audit and it was not a favorable outcome, or you didn't have things buttoned up and the state didn't feel like you were consistent in your application of the laws and the rules, you're probably going to get contacted within the next business cycle or audit cycle. That's typically a 36 to 48 month time frame. There's certainly what we refer to as audit cycles. And in this particular component, we're talking about the largest of the largest companies, the Fortune 1000, Fortune 500, where their activities are so significant and material, a small error rate creates a big windfall for the state. And so they almost become audited on a regular cycle. And it's not uncommon when we're representing clients of that magnitude, we'll be in the process of working through an audit, and they'll actually start the new audit while the other audit is still going on. So don't necessarily enjoy being in that place, but those sort of things happen. From time to time, states will identify or target specific industries if they feel like there's either a lack of understanding or maybe a trend of companies making independent decisions or interpretations of the law on a more consistent basis across companies in the same industry. And so they may spend some time in that industry just to clean that up, or they may, in some cases, they'll go down that path and change their laws. Interesting how audits of multiple companies in the same industry, all of a sudden that news travels back upstream to the legislature, and representatives start getting a lot of phone calls, and they decide, hey, we're going to change the law. When sometimes they'll change the law retroactively to accommodate that particular industry. The last couple here, disgruntled customer employee, and I know we're going to try to talk a little bit about real world examples. I'll share with you some of my stories along the way. Sometimes I share more than other times, but I'll share just a quick one here on a disgruntled customer and employee situation. We had a client who was operating in a multi-state fashion. They had business activities in just about every state within the continental U.S. They were facilitating a lot of their business through independent contractors, and meaning they didn't necessarily send employees into any of those states. They didn't have inventory in those states, but they did leverage local independent contractors to perform services on behalf of their customers. And that in and of itself is a physical presence within the state for sales tax nexus purposes. Meanwhile, at their executive headquarters, their CFO was engaged in some scrupulous activities, cooking the books, maybe said another way. And in addition to that, this particular individual had already responded to a number of nexus questionnaires and never disclosed these independent contractors performing these services, and did so intentionally to avoid having to comply with sales and use tax laws. Well, the company found out that the person was doing some illegal activities with regard to their accounting and finance. The FBI got involved. The person was arrested, and that person, a few weeks later, this company started getting phone calls, and they were being selected for sales tax audits. And there were 4 of them in about a span of 2 weeks. And they certainly are quickly caught on to the fact that something was going on. Ultimately, we found that this person had called roughly all the states he could think of to advise them that this company was intentionally avoiding sales tax. And so they were starting to audit them. It forced the company to have to proactively address the matter. And that's when we got contacted, introduced to the circumstances, and we had to do voluntary disclosures with 34 states to mitigate the eventuality that they were going to be identified and audited. Disgruntled customers is sometimes the same fate, except those usually end up looking like a class action lawsuit. And just last week, we were on a call with a gentleman out of Massachusetts who was representing a client who was being sued in a class action fashion around sales tax. Those are a little more comical from our perspective, because it tends to be a very minor transaction, and we're talking about literally consumers walking through a shopping aisle at Home Depot and deciding they don't like the way they were taxed and creating that level of noise. It's a very big distraction. It's usually not a material dollar amount or material issue that way, but it can create headaches. And finally, there are definitely random audits, just like income tax. The states have to keep everybody honest, including their auditors. And so they will assign random audit selection. I say random, I'm sure there's different ways they identify companies for audit in that regard. So again, plan for the inevitable. The better equipped you are to expect an audit, the more likely you'll probably never have one. Because as you can see, those activities that sometimes lead to audit are the fashion in which you manage your sales tax compliance. And if you manage it well, you're likely not to really show up on anybody's radar.
Yeah, and Jeff, just to comment on the nexus questionnaires, those are certainly, they've been around for a long, long time, even prior to Wayfair. But what we've seen, of course, over the last few years is that those are much more pointed in terms of the questions, and the the measure or the standard is very clear from a Wayfair perspective. So those questionnaires tend to be asking for revenue source in the state, number of invoices in the state, and those are very clear-cut answers to allow these states to make a very quick determination as to whether someone might have nexus or not. But definitely be on the lookout for those.
So now that we've been selected for audit, there's a number of sort of thoughts that goes through everyone's mind. I think there is a tendency to sort of assume the worst. And when I say assume the worst, these audits are generally just processes. I wouldn't consider them the same as getting pulled over for speeding when you're driving down the road. We know that when that happens to us, our blood pressure rises a little bit. We get a little bit nervous. I don't think it's necessary to have that level of angst around it, but certainly if you're not prepared, you're going to feel some of that. So that's undoubtedly the case. One of the things that we try to do before an audit even starts is think about, are we consistent in our application of sales and use tax? So we've got an audit indicator. We've got a letter from the state saying they intend to audit the books and records. Our immediate approach should be, okay, well, let's just see, is there anything that we're really concerned about? So the consistency of that process, we find that companies are regularly going through changes to their ERP and also changes to their sales tax calculation processes, some more sophisticated than others, but any level of change in that regard can lead to some real significant issues. You want to always have available data, and that doesn't necessarily need to be in a physical fashion, but you need to have access to a good set of data, be able to query that data as necessary for a particular audit. The querying ability is as important as the availability of the data, because you don't want to provide more than the auditor has asked for. That tends to be sort of the default for a lot of our clients, is they get an audit request, they don't want to take the time to try to bifurcate the data elements, and so they'll just provide the entire data set. Sometimes that doesn't cause a problem, but what it does cause sometimes is unnecessary issues, because you're dealing with an auditor who isn't going to understand your business, isn't going to try to understand your business, and is going to take the easiest way out relative to doing their assessment. And so the more data, the more visibility to transactions and volume and materiality they get access to, the more likely you'll have some erroneous assertions of taxability. As a result, we also want to understand, if there is risk, is it compartmentalized? Is there a way that this can be sort of blended in? I don't want to use the term hidden, because that implies that we're going to do something proactive and remove the data set from what the auditor sees. We're not suggesting that at all. But certainly when there are circumstances or issues that exist that are known, the way we present the overall data can influence whether or not those items are identified. One of the things that almost always happens when you're audited is you get the initial audit inquiry or the audit notice, and it'll be typically in a written format, and they will ask for 2 pages worth of data. You'll have 20 or 30 bullet points of data sets that these auditors are asking for and requesting. Understand that they come at this audit from a standard program that everybody's got to follow, and most of that data they're asking for is primarily to just confirm that you're providing them with 100% of the data that they need to see. So it's validating, it's reconciling between multiple data points and triangulating around the data elements to a degree that they're confident that nothing's missing. Everything's within their review process, and they're adequately equipped with what they need.
And Jeff, when you're talking about data, you're talking about not just like actual data in a file, you're talking about bank records. They might ask for tax return copies, all this other stuff, not just physical like
Exactly.
Excel data.
Yeah. The GL detail. There's quite a bit of stuff that gets asked for. There's some basic things that we always advise our clients to provide. Income tax returns, you might as well provide them. You're not going to avoid that. And they're easy to provide. And frankly, they already have access to them. And so I like to think about the things that I can provide quickly in response to those initial audit requests, and go ahead and push some of that information to the auditor quickly. Show an effort and an initiative to want to comply. Anything I don't want to show them, I'm going to hold back, and I may sort of trickle data to them over the course of time. More often than not, by the end of the audit, they've forgotten about that other data set or sets. It wasn't important anyway, wasn't necessary. Sometimes I don't provide it just because of the hassle of pulling it together. It's not always because it shows information I'd rather them not see. It's just the overwhelming cost of managing the audit. As you meet with the auditor, in today's world, most of those meetings are virtual. You want to be able to give a clear picture of both the business activity and the compliance process. You want to make it a short and consistent message or theme across both. And you want to gear your conversation towards what is working well. I equate it to if I was selling my house and I put the for sale sign out in the front yard, somebody knocks on the door, I'm going to show them all of the great features and great things that really shine and work well in my house. I'm not going to point out any of the leaks or rusty pipes or creaky floors. Doesn't mean they can't see them or find them or identify them, but I'm going to focus them on the areas that are well maintained and function appropriately. So that initial examination period being selected, there's a few things you can do, and just keep in mind you have a good bit of time between the time you get notified of an audit and the time things start to become real and you start having to provide the actual data. I think there's another poll question. Liz, do you want to kick us to that?
That sounds good. We'll go ahead and go to the next polling question. For the audience, this question is, when thinking about sales tax, what is your biggest concern? We have a couple of questions from the audience that we will address while we're waiting for your responses to be submitted. These questions come from Allie. Allie wants to know, how far back can states go to audit? Is there any statutory limit for the number of years they can go back to audit?
Yeah, that's a fairly common question and a good question. I don't think we would have addressed otherwise. So if you are not registered, but you did have an obligation to be registered and compliant, meaning you had nexus, you had a requirement to register and either charge tax or pay tax, the state can go back just about as far as they would like. Most of the states administratively limit that to 7, sometimes 10 years. So that's the general standard for a non-registered taxpayer that did have nexus. The state can't go back any further than the point at which you had an obligation to comply. So just because they have the ability to go back further, they have to also prove or assert that you had nexus. If you're registered and filing regularly, a regularly timely filed return, assuming no fraud's involved, there's usually a 36-month or 48-month limited look back and statutory limitation for the state. There are states that are there are anomalies that kind of fall outside that. There's some states that are 4 years plus current or 3 years plus current, so it's kind of a floating statute in that regard. But that's typically what we would expect to see.
Perfect. That's super helpful. We'll go ahead and close the polling question and review the results. We'll save the next audience question for a little bit later. Let me share those results with you all right now. So looks like the biggest concern is keeping up with changing nexus rules in each state, but pretty closely followed by understanding the taxability of your products and services. And of course, audits like we're talking about today can be a concern, and ongoing filings as well. I imagine the better your process, the less of a concern the ongoing compliance activities are. So thank you all for responding to the polling question. And we'll send it back over to Brian and Jeff.
Thanks, Liz. So now that we've kind of gotten ourselves inside of this audit process, it's imminent that the audit is going to happen. There's still a number of things and strategies that can be employed, not the least of which is setting the appropriate sample period. I will tell you that the evolution of technology has actually started to take its roots with the state and local governments. That took them a while to catch up. So we do see a lot of states, the more modern states, are leveraging more of a statistical audit approach, computer-assisted audits. In fact, what they'll do a lot of times is there'll be an auditor on the face of the audit, and there'll be a computer specialist behind the scenes, sometimes visible, sometimes not, who's really driving what set of data they're going to require, how they're going to accumulate it, and how they're going to project it. So one of the challenges that we have faced with some clients is when they have made a significant change in their ERP system, they've got two periods. The audit spans a period pre-ERP change and post-ERP change. And they may have awareness that the pre-ERP data just isn't what they would like for it to be. It wasn't as well managed. And so they're very excited about their post-ERP environment from a sales tax compliance perspective. And so they would love for the state to see that. But we really don't have a lot of control over that. So there's little tricks we'll try to play to try to influence the auditor towards one or the other. In one example I can give you, our client, this went back to, I think at the end of 2017, is when they implemented their new ERP system. The audit spanned 2016 to 2020. And so our approach was, well, here's the problem. We've got this legacy system where access to it is limited and challenging. And so for us to get any data prior to 2018 would take a number of months to get that for you. So we'd be happy to sign a waiver to allow us to gather that data and get that time. More often than not, the other side of that equation, I should say first, or I can give you everything from 2018 forward to look at, and I can get you that in a matter of days. So give them a choice. And I feel like anytime you're giving them a choice, they can feel like they have control, and their ability to feel that way will give them comfort. And so in that particular case, they chose to look at 2018 forward, and it was very beneficial for our client and worked out very well. Sometimes we know something about our business, like that ERP example. Other times we've had sort of fluctuations in our business where there's been a big transaction that was very unique, an outlier. And certainly to the extent there's that sort of thing, we want to avoid sampling and projecting based on outliers. Fairly obvious to everybody, I think, that it's just a mathematical equation, but it happens more often than you would know. In fact, a lot of times if somebody's decided they want to manage their own audit, and at the end of that experience, they get their audit work papers, and maybe they've even gotten their final assessment, and they bring it to me and say, hey, is there anything you can do with this? I will immediately go to, what was the sample? How was it picked? How was it chosen? What were the projection methodologies employed? And then within that sample, let me see the strata that were used or selected for that particular exam. I find there to be a low-hanging fruit in mitigating audits just by trying to challenge either the sample or the projection methodology. The other thing that I try to do, and in this next slide, I'll talk more about this, but I want to build some level of rapport with this auditor. And so it's not uncommon for us, knowing that there might be some significant risk in the underlying data, to disclose some elements of our risk. Things that I would look at and say, this is obviously going to be identified. There's no chance we're going to avoid it. Let's put it out front and in the open and spotlight it. So using my house example, I might have a real bad leak on one end of the house. And so what I might do is go into one of the bathrooms on the other end of the house, and there might be just a small little evidence of a prior leak. And I might point to that and say, this house isn't perfect. There's some elements here, and we wouldn't want you to be buying a bag of goods from us. We wouldn't say it that way. And point to that. Show a flaw. Show a few flaws, and it gets you immediate credibility to some degree. So it's not unheard of that we will actually lay out some of those problems. We had an auditor come in. I won't name the state. It was rather embarrassing for the state, but this client, it was a taxpayer that we did not represent prior to the audit, but this client calls us and says, hey, I got a real problem. I got the state coming in to audit me, and we have been based in that state for years, and we have never charged tax on our taxable services. It is of a magnitude that could bankrupt me. And so we actually spent a good bit of our time trying to figure out how were we going to avoid this. It just seemed too obvious to me that this was going to lead to a real issue. So my strategy was, let me show you all the dirty laundry. Let me give you enough information, and I don't want to use the hose technique, but I want to give you so much data that you're enamored by it and you can't not focus on it. There's too many variables that you're sort of perplexed by or engaged with. And so that's what we did. We just put all of this data in front of the auditor that really had nothing to do with the sales side of the business. It was the purchase side of the business. For whatever reason, I'm not going to suggest it was my ability, but the outcome was what we had hoped for. The auditor totally misunderstood the nature of this business. We confused him with our description of how it operated and what it did. And he, at that point, just left the sales side, the revenue side alone, as if it wasn't taxable. And they did such a poor job of really understanding the business that when the audit was starting to be wrapped up, the auditor reached out to me and said, hey, I've got to write a summary page of this company and my audit routine, and I'm really struggling with that. Could you help me write it for his supervisor to review? And part of me was excited by that. I was thinking to myself, well, this is great. I have control. The other part of me was like, well, I can't lie. So now I'm really in a position where I'm going to have to put pencil to paper in a way that's strategic enough to be successful, but not to dissuade or falsely state anything. So anyway, audits and auditors come in a lot of different shapes, sizes, and forms, some of which are better than others. It's not always true that a bad auditor and I throw these terms and these adjectives around a little bit freely because I was an auditor, and I know how we were perceived. But you may have an auditor that's just not they might be a dull point. They just may not be the sharpened pencil in the pack. That may be a good thing, and it may be a bad thing. It's hard to predict whether a good auditor is smart or a good auditor is dumb. Either of those could be bad or good. So there's no real predictive index that we can employ in that regard. The other thing that I think is important to understand is, and I said it earlier, the audit's going to span a period of time. It's going to take a while. And so more often than not, our clients, particularly those that have customers who are exempt, will have inadequate exemption certificates on file to substantiate those exempt sales. And so as a result, we'll encourage them to leverage and use that time during the audit, the beginnings of the audit, to get data, to get exemption certificates, or to get what we refer to as an XYZ letter. An XYZ letter is a generic term. A lot of the states are familiar with it and use it, but it's an affidavit that you get from your customer that says, while we're not exempt, we did actually self-accrue and remit use tax on purchases from your company. And so we've already satisfied the sales or use tax liability. Or perhaps they've been audited for the same period that you're under audit. And that XYZ letter serves to explain that that period and those transactions have already been addressed. So that's just what an example of an XYZ letter looks like.
Hey, Jeff, let's just pause here for just a second, and I'll address one of the questions, or at least read one of the questions for you to respond to. And this is from Justin, and he asked, do most audits relate to an entire corporate structure, or is it limited to one entity within a larger organization? And he provides a little bit more background information. We're a conglomerate of companies, and I worry at times that an invoice may not match the entity name that is actually providing the services or through which the money actually flows, and trying to see how to begin mitigating that.
Yeah, so there's probably we could probably break that whole storyline down into a few different questions. I'm going to stay at the first part of it. More often than not, the audit does select a single legal entity, typically driven by a federal ID number. So we represent a number of companies that have a number of different legal entities within their structure and are structured in any number of ways. I will tell you that the states of Washington, Ohio is this way. They'll try to see what they can find in the way of your business structure. A number of other states will have some questionnaires that they will present to you at the beginning of an audit, asking you to answer some general questions. And in those questionnaires, there'll be questions that kind of drive towards, are there related entity transactions that they need to be aware of? And they're really getting at, maybe there's a more expansive audit. It is difficult to avoid some of that, but we had this situation in Washington about a year ago. It was a company they're actually based out of Canada, but they had about 400 different companies within their corporate structure. And their biggest fear was what you just asked. What happens when somebody knocks on the door and wants to know all of those entities? Now, the reality is all of those entities didn't necessarily have activities in this particular state, or if they did, it wasn't material. Maybe they didn't have nexus. But there was enough of that worry that we needed to mitigate it. We fought with the auditors, the auditor supervisor, went down a number of streams of thought. To be honest with you, I was not successful in pushing them off of that. What I did was I have some relationships in different parts of the country. Some are sometimes good, sometimes they're not so good. But I reached out to one of my relationships where this gentleman was a former auditor with the state in question and had his own CPA firm. And he had a great deal of experience working down this path and mitigating that. So we actually brought him in as a special advisor, and he was successful at achieving that limited sort of exposure and risk. So it's a valid thought or a valid concern. And I will tell you, the states would like to know those things. In other states, it generally doesn't come up as often as you would think, or at least the way we manage the audits avoids that issue pretty often. It's rare that it turns into that. This next slide sort of builds upon what I was talking about on the earlier slide. You know, the managing the audit is as much managing the auditor. The relationship is key. I like to tell people, look, treat the auditor with respect. You're not going to get anything out of having a sort of cystic relationship with them. I do recommend highly you identify a single person to manage the audit from beginning to end. You've got to have a consistent sort of messaging that's going back to the auditor, particularly on how you answer questions and which questions to answer. Sometimes, like I said earlier, we manage a lot of audits for clients. I don't like to be in a position where I'm not managing the entire audit. I do have a client that's going through an audit in the Northeast at the moment. And what happens is they'll get a question from the auditor that I know how I could or would answer it. And I can tell my client how I could or would answer it, but my client being in the position they're in, they're not able to answer it the same way because they're in the business. They have the knowledge. They can't say they don't know, or they can't say that I think. They are expected to know. So I do tend to try to encourage clients to put someone in charge of the audit that's more executive level, not into the details, so that they can have the answer, I don't know, available to them. I think limiting the auditor's access to data and other people within the business is something we've kind of talked about at this point, particularly on the data side. I already mentioned, if I can, I'm going to get them stuff I want to show them in their hands quickly. I want to show an effort, an intent to comply. And it's okay, and I do this sort of strategically. I will ask questions during the initial part of the audit. I might do so even though I know the answers. Sometimes I'm wanting the auditor to have a perception that I don't have all the answers, that I don't know everything about their state tax policy. And I'm staging that specifically and intentionally so that I have a little more flexibility in the long run or at a later stage. It also can help me to do a couple of things. I can make the auditor feel a little more knowledgeable and maybe even superior, and give them confidence and show them gratitude in a way that makes them feel good about the relationship we've got. At the end of the day, these auditors have a lot of discretion, particularly at the very initial stages of the audit and during the assessment process. As the audit starts to near the end, they have a little less, if not a lot less, discretion. So Liz, I think we have another poll question, and then we have a few more slides.
That sounds good. All right, so this is our third polling question. And this question is, do you anticipate seeing a change in the number of sales tax audits in the next 2 years? So we kind of talked about this a little bit, alluded to how the answer to this question tends to differ from the answer to the question of, have you seen a change? So this is about looking forward and what you anticipate. So go ahead and let us know what your expectations are. And I think we have time for another audience question. So glad we were able to get to Justin's question. That was a really good one. And then I think we had another one from Allie. What is the remote seller's position if a qualifying seller did not register with the state in a timely manner to collect tax and did not collect any taxes, but now is held liable for those back taxes as a result of the audit? So there's a lot there. Is that a question that has a high level answer, or would that be a better one to address after the webinar?
No, I can answer that. Yeah, it's an unfortunate position to be in. Whether you're a remote seller in a fashion where your nexus is economic in nature, or whether it's a physical nexus scenario, either way, if you've got history and have had nexus, you are prone to being assessed on those sales that should have been taxed. Your opportunities to mitigate that are a combination of things. You may have, depending on the type of business, and you'll understand, I think, what I mean by this, but you may have in your contract specific language that holds the seller ultimately liable for any sales tax, whether or not that sales tax was applied to the original invoice. And those are typically larger projects, larger engagements. If you're dealing with direct-to-consumer type transactions to people that you're selling to everybody that lives in their houses, you're not going to accomplish anything of that nature. Once that invoice has been issued and paid and satisfied, you have no further legal authority to go back and collect that tax. When I was describing the contractual language, now you get into contract law. It's not the state sales tax statutes that would apply under that condition. You just have established a contract between two parties that says what each party is responsible for. So those are a couple of scenarios or situations. You also have the opportunity to go back to those customers, and you can do one of two or three things. You can ask them for an exemption certificate. You can ask them whether or not they've already paid the tax, the XYZ letter component we spoke about. Or you can go back and ask them to pay the tax. You could send them a letter and say, we've been assessed, we've been advised that this transaction is taxable, and that you as the consumer have the responsibility for paying that tax, either as a consumer's use tax or as a sales tax imposed by the seller. It could be a seller's use tax as well. I won't go into that detail if anybody's on the call questioning that. So you could go that approach. Again, that's extremely challenging, particularly if you have a small product or small dollar product with large volumes. But even if you're dealing with consumers who are corporate entities and they're larger, sometimes you just don't want to air that dirty laundry. But you are very limited to what your options are, and you are not in the best place when those situations or circumstances exist. Sorry to say.
Well, it's good to address that, though. I think it's a good question. We had someone else in the audience with a similar question, and it sounds like that does come up from time to time. So good to have some direction there. We're going to close the polling question, take a quick look at those results. And similarly to what we discussed earlier in the webinar, majority of the audience does expect the audits to become more frequent. But then many of you are not sure, expect the audits to stay the same. And a few of you do expect the audits to be less frequent. So thanks for sharing your opinion with us. And we'll close the poll question and send it back to Jeff and Brian.
Yeah, and I think what you all can expect is those that don't expect any audits are probably going to get a call in the next week, and those that do expect audits will never get another call. That just seems to be the way it plays out. It's funny sometimes when clients ask for us to do an overall exposure analysis, and we're looking at, back to that remote seller question, we're looking at activities across all the states, and we're, in this case, assuming they didn't have Nexus, or they had Nexus, but they weren't registered and complying. So we start down this path of, okay, well, what do you think, Jeff? Do you think that's a high-risk state or a low-risk state? Those are hard questions to answer. The high-risk states are the ones that knock on the doors. The low-risk states are the ones that never show up. But we do apply risk quotients to circumstances like that. I mean, there's certainly some truth to the fact that the more populous states have more, I would guess, more computer savvy audit programs. They're more capable of reaching out across a larger spectrum of people, and they probably have more audits, but they got a heck of a lot more people to audit too. So it all kind of balances out. These last three slides are just kind of wrapping up sort of our circumstances in terms of where are we at the end of the audit process. A lot of the effort that I think is most valuable is in the upfront analysis, the preparation for the audit, the management of the audit. By the time you get to these late stages of the assessment, you start to get a little bit hamstrung and you start to get a little more targeted. So I think when we see this initial assessment come out, they can come out in two varieties. Most of the audits will come in what I call work papers. So it's a preliminary assessment, basically saying this is what we intend to assess you. Do you have any mitigating documentation or arguments that would support these being removed from the assessment? Along this time frame is when you're likely to get a request for a statute of limitation waiver. That's basically giving the state more time to assess you on these open periods. And you might be thinking to yourself, well, why would I ever sign that? Why would I ever give the state more time? More often than not, the advantage on the statute of limitation waivers is to the taxpayer. Sometimes we do find that auditors drag out audits and these things go on for years and they just keep doing these waivers, and that there's an end point to that you want to get some consulting support to help you out with that. Otherwise, I tend to find executing waivers to be okay, and that's basically, again, giving us all more time to evaluate the preliminary assessment. Once you get that assessment, hopefully you've got a little bit of a feel for where you're going to get hit, but focus on the large items, the large assessment categories. Some of us hate to pay $1 of extra tax, but as I used to tell my taxpayers when I was an auditor, if you have no liability and no risk, you're probably spending way too much time or money on your compliance. There's a balance. There's a cost-benefit analysis you got to do in terms of how accurate and specific you're going to be with compliance. So you should expect some level of risk and some level of liability. And it's at this point where we're able to then provide exemption certificates to the auditors. Most of the states, if you didn't have the exemption certificate at the beginning of the audit, most of the states are going to give you pretty good latitude to accumulate those exemption certificates while the audit's going on. We already talked about XYZ letters a few times. It's okay and appropriate, frankly, and it happens even in my scenarios. Sometimes I'll see the auditor assess something, and I think that they're really applying their own interpretation of law, and I don't believe it's accurate. So I ask them for their statutory support. Sometimes we'll go back and forth, and I'll convince them that their interpretation of the law in this particular circumstance is wrong. Sometimes we don't get to an agreement in that regard, but at least I know what their position is, and what I'm trying to figure out is exactly why they believe that assessment is accurate or that item's taxable. We talked already about projections, sample periods. You do want to pay attention to that. The more statistical, computerized sampling and projection methods they use, the more difficult it might be to challenge that. It doesn't mean you don't challenge it. You ask questions, understand it, make sure you're comfortable with it. There can be some negotiated settlements. They can come in a lot of different flavors and varieties. I do have clients that'll kind of convey to me that real flippantly that I just settled that audit. They came in and assessed me $100,000. I told them I was only paying $50, and we walked away with $50. You know, that may happen. It probably doesn't happen that way. There's probably other factors that were involved, but there can be some negotiated settlements. There can be some give and take at the end of the audit, and it can be based on, you know, ambiguous interpretations or ambiguous transactions in that regard. Once you get past that work paper, that preliminary assessment, you start to lose ability to negotiate with the auditor themselves. And now you're getting into more what I call an appeal type scenario. In a lot of states, that can be fairly informal. It can be simply meeting with that auditor's supervisor along with the auditor. You may come to some good conclusions that way. There might be an informal protest or hearing process that state has in place for you to execute. That's usually a next level up person that's going to evaluate the case based on what they have in front of them. Sometimes you can find yourself in a position to get more data and support that. Then you start to get into more formal appeals where you probably want some level of external support, whether that be a consultant. Sometimes if you get to the court level, you're going to need an attorney. But it's just important to understand that you are afforded a number of different appeal levels and opportunities depending on your circumstances. So at the end of the day, back to the original slide, you know, where I talked about just be ready, prepare yourself for the inevitability of an audit, and just do the right thing as best you can. Sometimes I have clients that they'll look at their use tax accrual side and they'll say, there's just no way I've got time or energy to focus on paying use tax on purchases that the vendor didn't charge me sales tax on. That's okay. I get that. I probably wouldn't do it either. I might consider, depending on the volume of that activity and the potential of that risk, booking an accrual in anticipation that I may owe something in some state someday. So having a little bit of flexibility in the financials to offset an eventual tax assessment isn't a bad idea. But, you know, this here is a list of just items to consider. Keep good records, understand statute of limitations, the 7 to 10 year look back period if you're not registered. So you want to have good records to substantiate your activities. And at the end of the day, if you don't have records, you can assume that the state's just going to assess it. It's going to become taxable. I was on the phone just this afternoon with another client. They're getting audited in Florida. They've got a $650,000 sales tax assessment. It's a preliminary assessment. And all it is the difference between their income tax return and their sales tax return revenues. They just have differences, and they're natural differences. They're things that almost every company has. They're reconciling revenue recognition type differences, usually fairly easy to explain away. But again, in the absence of the facts and the documentation for the auditor, you can expect it to be assessed, as ridiculous as it may seem sometimes. So I think we have a last poll question, and I know I've kind of consumed most of our hour. We may have a couple of questions.
Yeah, so this is the fourth and final polling question. I'm really enjoying hearing all the stories that you're sharing. For the audience, the question is, are you interested in learning more about Tax Connect? So you can let us know that. For those of you who had questions that we didn't get a chance to answer today, we'll make sure that you get Brian's email address so that you can reach out to Brian with your question. Highly recommend that you do so. And then wanted to kind of ask a closing question to Jeff and Brian and just say, like, we can hear throughout these stories that you have clients bringing you in at different points. It sounds like sometimes you get the call when someone's already been audited and now they're trying to figure out what to do. When's the optimal time for someone to give you a call?
I mean, this may sound self-serving. If you're experienced with audits, or you have comfort in the sales tax arena and you understand your business processes, I encourage you to manage your own audit. I don't think you need external support. Most of the companies we work with are small to mid-sized businesses, generally don't have any tax department to speak of, and so they're really trying to manage something that's fairly foreign to them, probably don't have a lot of experience in it. So I encourage them to let us know as soon as they get the letter, this is what we're facing. We can kind of do a pretty quick survey of their risks and give them some idea as to what they're looking at and whether or not they need for us or someone else to support them, or maybe even take over and manage that audit.
Well, thanks for answering that. And Michael in the audience pointed out that we could add we're already working with Tax Connect's response, which is a great recommendation. So thanks, Michael, for letting us know that, and glad to know that you are currently working with Tax Connect. We're going to go ahead and close the polling question down to give Jeff and Brian time to close.
Hey, Liz, thank you for that, and we appreciate the audience participating. And like you said, I know we have a handful of questions here that we didn't get to. We'll definitely follow up with you individually to address those. So definitely thank you for participating, for all of the questions. We look forward to seeing you guys in the future. Thank you.
Thanks, everyone.